Tal Hul, Chief Market Strategist with JPMorgan Asset Management, joins us with his market take. Tal Hul, good morning and thank you for joining us. Last time when we interacted with you about 3 months ago, you were slightly cautious on India. Now, from there and now, the scenario perhaps for India has changed completely. The consensus on the street is that rupee has stabilized and Indian economy has a bottom in place. What is your sense?
No, I tend to agree. I think compared to 3 months ago, my view on India is slightly more constructive on two bases. First of all, if you look at the macroeconomic data, we are starting to see things stabilizing. It's far from a solid recovery, but at least we're getting a better feel that the economy's bottomed out. I think secondly, I was quite pleased to see how the rupee has reacted to the whole news of the Fed tapering announcement back in the middle of December. So I think that again illustrates that a lot of the policies put in place by the Reserve Bank of India has helped reinforce market confidence. But I think overall, compared to some of the other markets in Asia, I would still put India perhaps in more of the middle of the rank rather than right at the top at this point in time.
Further then, Tai, how do you see markets responding to drawdown in bond purchases from the Fed? We've seen how the markets reacted at the taper light event earlier previous month. But what's the sense? If there is some more talk about taper, if the tapering quantum is increased in 2014, how are the markets likely to absorb it?
Well, I think obviously the Fed is keeping the pace of tapering very much data dependent. And we do believe that they will gradually and in an orderly manner reduce that tapering or the QE down to zero by the second half of this year. I think the market is largely expecting that. And of course, if your scenario of an acceleration in tapering does take place, I think it does suggest that the U.S. economy is stronger than expected. And that's actually good news for equities. If you look at the immediate reaction of the markets to the Fed announcement on tapering, it's actually quite positive. I think the market is now adopting a more mature view of the whole policy movement, and they view that the Fed normalizing policies is actually a stamp of confidence on the pace of economic recovery. So that's the good news for the stocks. Obviously, that could change depending on the market sentiment. But overall, if the Fed does accelerate its tapering, I do believe that markets like the US or Europe, developed markets, and also economies with high exposure to the US, I think those would benefit more.
2013 was a year of divergence. Developed markets did exceptionally well. Global growth made a comeback. Fear is no longer occupying center stage. Do you think the developed market trade could extend itself in the first half of 2014, or now emerging markets could make a comeback?
Well, I do think developed markets are likely to, remain very favorable in 2014, albeit that, the 30% increase in S&P 500, I personally think is quite difficult to really, achieve that again in 2014. But nonetheless, I think a 10-15% upside to equity in the U.S. is not unreasonable. For emerging markets, I do think that it's going to be a time to be selective in emerging markets. Countries that have high exposure to U.S. and Europe who benefit from the recovery are likely to do well. And also, with Fed tapering in mind, countries with a current account surplus, for example, in Korea, in Taiwan, they do have a brighter currency outlook. And therefore, from a total return perspective, it does call for a great deal of optimism. For countries like India, Indonesia, I think the path should still be reasonable, but a bit more challenging compared to other emerging markets with a current account surplus. The truth is, India has come a long way in repairing its current account position. We've seen quite a drastic decline in current account deficit. That's good news. And I think political developments, as we get more clarity, again, we may see investors to be more optimistic on India as we approach the middle part of 2014.
In the near term, though, Tai, from now up until to the run-up of the elections, do you sense that the market is going to be volatile and range-bound, or do you see it making new highs this time around?
Well, I do think that the political development, that very much depends on whether the news between now and the election will give us a lot more clarity on who or how the new government will look like. The reality is the market tends not to react after the election, but as the campaign progress and opinion poll, et cetera, start to form, that tends to shape the market along the way. But I do expect more volatility, not only from politics, but also, as we discussed earlier, how the market shape its expectations on Fed tapering, as well as other central banks' policies, not least the RBI. I think that's going to be critical in shaping the market view. I do believe that we could still see record high in Indian equities, albeit the extent of rally may not be as impressive as other parts of Asia.
A final question. In asset management, it's all about absolute returns and relative performance. So if a client walks up to you with a $1 million check, not a big amount, and if the question is, look, Ty, you're free to invest. I want to double my money in 3 years. How would you invest?
Well, I think the key here is diversification. While you may want to put money on one large bet, what we found is that consistent performance over time is only achieved via diversification. The reality is to double money in 2 years, I think is extremely difficult. But the reality is a great deal of diversification and also really rebalancing towards equities, including emerging markets. I think that's the ticket to a strong performance in asset management.